Wall Street is worried about Vegas, not the city, not the concept, specific properties, specific buildings, specific investments that keep analysts awake at 3 in the morning, staring at spreadsheets that don't add up. I got my hands on something interesting. Internal reports, earnings call transcripts, investor communications that weren't meant for public eyes, the conversations happening behind closed doors, the properties making money managers nervous, the buildings that show up in red on financial models across the country. 10 of them, 10 properties where the smart money is getting anxious, where the people who actually understand balance sheets are asking uncomfortable questions, where investments that looked solid 2 years ago now look like liabilities. This isn't about guest experience. I've covered that, the declining service, the hollowed out amenities, the gap between price and value. This is different. This is about money, pure money. Debt loads, revenue trends, operating margins, the cold mathematics that determine whether a property survives or becomes a write-off. If you own stock in gaming companies, you need this list. If you hold bonds in casino operators, you need this list. If you're just curious about which properties are financially unstable, which buildings might not exist in 5 years, which investments are keeping CFOs up at night, you need this list. Let's count. Number 10. Circus. The clowns are gone. We've talked about that before, but here's what we haven't talked about. The owner. Real Resorts acquired Circus as part of a larger deal. Got the property along with other assets, figured they could turn it around. They figured wrong. Revenue has declined every year since acquisition. The family-friendly positioning that once made Circus a destination has collapsed. Families have options now. Better options. They're not driving to Vegas to stay in a dated property with discontinued entertainment. So what does an owner do with an asset that keeps losing value? They explore strategic alternatives. That's the phrase in the investor communications. Strategic alternatives. Investor code for, we might sell this, we might convert it, we might do something, anything other than keep bleeding money. When you see strategic alternatives in an investor report, start the clock. Something's about to change. Number 9. Excalibur. Same ownership group, same concerns, same conversations happening in the same boardrooms about the same problems. Budget positioning was supposed to be Excalibur's strength. The affordable castle. Vegas for families who couldn't afford the premium properties, a market that should be recession-proof. It's not. Budget travelers have vanished. Not because they don't exist, because they can't afford even budget prices anymore. The middle class that used to fill Excalibur is drowning in debt. Credit cards maxed, savings gone. The Vegas trip that used to cost $800 now costs $1,500 even at budget properties. Revenue per room declining year over year. The metric that matters most to investors going the wrong direction. When revenue per room drops, profitability drops. When profitability drops, the property becomes a drag on the portfolio. When the property becomes a drag, those strategic alternative conversations start. Excalibur and Circus share ownership, share problems, might share the same fate. If you care about understanding how investment decisions shape the world around you, subscribe now. Because this list isn't just Vegas content, it's a case study in how money works, how debt crushes, how the numbers that move in boardrooms eventually change the buildings you walk through. That's what this channel is about. Number 8. The Strat. That tower at the north end. Impossible to miss. Over 1,000 feet tall. Observation deck. Thrill rides. The needle puncturing the Vegas sky. Owned by Golden Entertainment. Golden Entertainment stock has not had a good year. Down significantly from its peak. Analysts questioning the portfolio. Investors nervous about exposure. And at the center of those concerns sits the Strat. The location kills it. Isolated at the far north end. Away from the foot traffic. Away from the convention center. Away from everything that makes strip properties valuable. Tourists don't wander up there. They'd have to make a deliberate choice. Walk past a dozen other properties, commit to the journey. They're not committing, occupancy struggling, and here's what makes investors particularly nervous. The tower needs modernization. Significant capital investment to remain competitive. Updates that cost real money. Money that Golden Entertainment might not want to spend on a property that isn't generating adequate returns. When investors look at the Strat, they see a choice. Invest heavily and hope for turnaround. or cut losses and move on. Neither option looks great right now. 3 properties. Circus exploring alternatives. Excalibur dragging down its ownership group. The strap-making Golden Entertainment investors question their exposure. Still the minor leagues. Struggling assets. Concerning trends, but manageable losses. Numbers 7 through 4 are where investor blood pressure starts rising. These aren't properties with problems. These are properties attached to debt loads that could sink entire companies. Number 7. Sahara. This property has burned through owners like matches. The original closed in 2011. New owners reopened it as SLS in 2014, poured money into renovation, modern design, fresh concept. Sold at a loss. Next owners rebranded back to Sahara in 2019. Tried to reclaim the heritage. Tried to find an identity that worked. Still struggling. Current investors watching occupancy numbers that don't justify the purchase price. That's the key phrase. Don't justify the purchase price. When you buy a property, you're betting it will generate returns that exceed what you paid. That's the whole game. Buy low, generate high, profit. Sahara investors bought high. The property is generating low. The math doesn't work. And when the math doesn't work, investors have 2 choices. Double down, pour more money in, hope the turnaround comes. Or cut losses, sell for less than you paid, take the hit and move on. Sahara investors are running out of patience. Every quarterly report that misses projections erodes confidence. Every month of sub 50% occupancy makes the write-off more likely. The smart money is nervous. Getting more nervous every quarter. Sahara investors paid premium prices for a property that delivers economy returns. But here's the thing, they're small players, private money, limited exposure. If Sahara fails, it hurts, but it doesn't make headlines. Numbers 6 through 4 are different. These are properties attached to publicly traded companies. Companies with billions in market cap. Companies where millions of Americans hold stock through retirement accounts and pension funds. Companies where these specific properties are dragging down entire stock prices. When Wall Street gets nervous about casinos, these are the buildings they're nervous about. And the names on this list will surprise you. Number 6. Planet Hollywood. Prime strip location. Center of everything. Owned by Caesars Entertainment. And that's where the problems start. Caesars carries $12 billion in debt. $12 billion. Interest payments alone crushing over $1 billion annually. Every property in the Caesars portfolio gets measured against that debt. Every underperforming building makes those payments harder. Planet Hollywood is underperforming. Declining revenue per room. Service complaints spiking. Renovation promises unfulfilled. Every quarterly report shows the same story. Projected numbers missed. Actual numbers disappointing. The gap between expectation and reality widening. Investors read those reports. They see Planet Hollywood dragging down the portfolio. They ask questions on earnings calls. Hard questions. Number 5. Flamingo. Same Caesars portfolio. Different problem. The oldest resort on the Strip requires constant capital. Old buildings need work, plumbing, electrical, infrastructure that dates back decades. Keeping Flamingo operational costs money. Real money. Every year. And the returns don't justify the investment. Analysts have asked repeatedly why Caesars keeps Flamingo open. The land is valuable. The operation isn't. That gap between land value and operational value makes investors nervous. Because we've seen what happens when that gap gets too wide. Tropicana. Same owner. Same math. Different outcome. Demolished. Number 4. Alenquer. Completes the troubled Caesars trio. The high roller observation wheel generates revenue. Tourists pay to ride. Photos get taken. The wheel earns its keep. The hotel attached to it generates questions. Thin walls. Small rooms. Mediocre reviews. Investors look at Link and see a profitable attraction attached to an unprofitable hotel. They want the wheel. They don't want the struggling rooms dragging it down. 3 Caesars properties on one list. 3 underperformers in one portfolio. And Caesars stock down over 40% from its peak. The connection isn't coincidental. These properties are dragging the entire company. Every investor in Caesars watches these 3 buildings like a doctor watches vital signs. Weak performance here means weak stock price everywhere. Pension funds holding Caesars stock feel it. Retirement accounts with gaming exposure feel it. Money managers across the country tracking these specific properties because these specific properties determine whether their clients make money or lose it. But Caesars isn't even the most nervous ownership group right now. Numbers 3 through 1 are properties making their investors genuinely panic. Number 3, Luxor. MGM Resorts owns it. MGM carries over $30 billion in liabilities, even bigger debt load than Caesars, even more pressure on every asset. And Luxor has been systematically neglected for years. Capital expenditure declining annually. Every year, less money spent, less maintenance, less improvement, less investment in the future. When a company stops spending on a property, they've already decided its future. The math has been done. The conclusion reached. Luxor isn't being maintained, it's being harvested. Extract what revenue remains. Spend nothing. Let it decline until the land value exceeds operational value. Then do what Tropicana did. Investors see this pattern. They're not stupid. When capital expenditure drops 5 years in a row, the signal is clear. This property is being prepared for disposal. Not investment. Disposal. Luxor is being harvested, not maintained. Every investor watching MGM knows what that means. But numbers 2 and 1 aren't just making investors nervous. They're making investors question whether the entire Vegas model still works. 2 properties, 2 massive red flags, and implications that reach far beyond any single stock price. Number 2, Fontainebleau, the newest tower on the Strip, the tallest building in Nevada, $3.7 billion of glass and ambition, and investor anxiety through the roof. This was supposed to be the success story, the proof that Vegas could still attract capital, still build monuments, still deliver returns that justify billion-dollar bets. The bond offering was massive. Investors lined up. Money poured in. Everyone wanted a piece of the next great Vegas property. Now those same investors are watching the numbers. And the numbers don't look good. Fontainebleau needs to generate over $1 million daily just to service debt. $1 million every single day, before profit, before returns, just to pay the interest on the money borrowed to build it. Occupancy reports suggest they're nowhere close. Rooms priced at premium levels sitting empty. Gaming revenue below projections. Restaurant traffic disappointing. Every metric investors care about trending wrong. Bondholders watch each earnings report with growing concern. The questions multiplying. Can this property service its debt? Will returns ever materialize? Did we make a terrible mistake? Here's why Fontainebleau makes the entire investment community nervous. It was supposed to prove something. Vegas can still work. Vegas can still attract capital. Vegas can still reward investors who take big swings. If Fontainebleau fails, it proves the opposite. Every future Vegas project becomes harder to finance. Every investor becomes more skeptical. Every pitch meeting gets harder. The ripple effects extend far beyond one building. Number 1, MGM Grand, the flagship, the crown jewel, the largest hotel in America, and the property making investors most nervous of all. MGM Resorts owns it, $30 billion in liabilities riding on that portfolio. MGM Grand is supposed to carry the weight, the property that proves the model works, the asset that justifies the debt, the building that makes investors feel confident about their exposure. It's not doing that anymore. Revenue per room declining. The metric that matters most going the wrong direction. Maintenance visibly deferred. Walk those hallways, see the carpets, count the broken elevators. Service complaints spiking. Reviews that read like warnings. The crown jewel showing tarnish. And investors notice. When MGM Grand struggles, MGM Resorts stock suffers. Direct correlation. Every missed projection at the Grand translates to stock price pressure. Every negative review adds to analyst concerns. Every quarter of decline makes shareholders more nervous. When MGM Resorts stock suffers, the entire gaming sector gets nervous. MGM is the bellwether, the indicator, the company everyone watches to understand where Vegas is heading. If MGM can't make their flagship work, what does that say about everyone else? One property's problems rippling through billions of dollars in market value. That's how important number 1 is. That's how nervous investors have become. 10 properties, 10 sources of investor anxiety. But here's what should make everyone nervous. Not just stockholders, Everyone. These aren't small-time operators worried about one building. These are publicly traded companies. Billion-dollar debt loads. Pension funds with exposure. Retirement accounts holding these stocks. When Vegas struggles, it doesn't just affect Vegas, it affects portfolios across America. Your 401k might hold gaming stocks. Your pension fund might have casino exposure. Your retirement might be partially dependent on these properties. Figuring it out. The money managers are nervous. The analysts are nervous. The bond markets are pricing in risk that didn't exist 2 years ago. Gaming sector recommendations shifting. Buy becoming hold. Hold becoming sell. Capital flowing out of Vegas-heavy portfolios. When investors get nervous, capital gets scarce. When capital gets scarce, improvements don't happen. When improvements don't happen, guest experience suffers. When guest experience suffers, fewer visitors come. When fewer visitors come, revenue drops. When revenue drops, investors get more nervous. The cycle accelerating. 10 properties making investors nervous. But the nervousness isn't contained. It spreads through stock prices, through bond markets, through capital allocation decisions, through the entire financial ecosystem connected to Vegas. The house always wins. That's what Vegas told us. That's what investors believed when they poured billions into these properties. But the house is struggling now. The house is bleeding money. The house is making the people who bet on it question everything. 10 properties, billions in debt, and a market that's starting to wonder, does the house always win, or does the house finally lose? The investors are watching, the analysts are calculating, the bond markets are pricing, and the answer is coming, whether Vegas wants it or not.